Okay, I'm sitting outside. It's a nice evening, not too much global warming today. The I'm going to make the and if you hear a bird singing, I know you complain about my music, and rightfully so. Okay, just because my uncle got me, tries to make me a little more appreciative of some of that music. Okay, I'm not going to do that anymore, but please don't complain about the birds. Whatever. Okay, now this is the last part of my tax equity, and I'm going to my website and I'm going to do the same thing I did before, which is it's not really the last section. It's part three. We're doing some financing. The things that I still need to address a little bit are this minimum gain, and we'll certainly, now that I think I understand it, address the inverted lease. I'll do that in a different video because I've got to make a little example of this. So now, in the other videos, we've gone through all the structuring and the basics, and now we're going to get to the financing. Okay, and as with the other file now, I have put these little things that says I'm going to attach a little file to them, and I haven't attached the file yet. And by the way, if you open a file and it's got some, and we're going to speak about back leverage today, and back leverage in the context of yield-based flips, first of all, and then back leverage is, so yes, and kind of the credit issues associated with when the flip can occur if it's not at a given time period. And then we're going to work through solar projects with typically probably more time-based flips, so they could have both, and ITC, where you can, since you're receiving a bunch of tax equity, and the tax equity is going to be really very greedy. They're just going to they're not going to want to finance the project. They're going to want to put their money in right when they get the ITC back. So basically, they don't put much money in. But then to resolve that, you can have a tax equity bridge loan. And when I first heard about this, I go, oh, no, tax equity bridge loan. That must come from the tax equity. There must be kind of a tax equity financing of the project and a developer financing. The developer has back leverage. And no, no. It's a simple it's almost like an equity bridge loan. And we're going to go through some of those. And I'm going to talk just a little bit about circular references that may or may not arise with all of that. And probably it's even though it's kind of my passion to resolve these circular references and show you UDFs and blah 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 blah, it's probably really not that big a deal to worry about in these transactions. So now let's go to the files. Now, if you open a file, if you download a file, I think it's tax equity cases, and then if it got one of these pink things on the top, you go to properties, and down here, or is it in security? No, it's right here. There'll be a little thing that says trust the document, and you have to sometimes press OK, and I think you might have to open and close the file again, and you have to do that with the generic macros. So as we go through this, oops, I guess I've got some police chasing after somebody or something like that. Okay, let's go back and just talk about some of these things. So that again, what the file I just showed you, I'll go ahead and open it, and I'm going to make some very general points that for now seem so ridiculously obvious to me, and why they haven't in the past, I really kind of don't understand. And I guess, why didn't I just open this? Did I just open it? I thought I did. Oh, excuse me. Okay. I'm not going to be nervous about this video today because it's the best part of my day, because I've just spent hours and hours and hours balancing a balance sheet. And you can say, why? Well, you can't even balance it. It was really a pain. So in this example, we've got some. I'm going to work through some of the back leverage kind of arguments now, or discussions. Now, let me just begin by saying again, the first time I heard back leverage, I thought, what are you doing, you greedy tax equity people? You're going to take the kind of skim all the money on the top, get your preferred position out. Then what's ever left over is a dividend to the developer, and you're going to use that dividend the developer gets to repay, to size the debt. It sounds to me like some subordinated debt. And a little bit, there's a little bit of truth to that, but if you think about tax equity, the kind of general idea that don't tell the IRS this, but basically the tax equity wants to take their money out first, and they want to get the tax benefits, and they leave a whole lot of the cash flow to the developer anyway. And increased with increased tax incentives, including the ITC and the PTC, for the tax equity, you notice I have to kind of think through these things. The cash flow, because the tax equity partner wants all those tax benefits, the cash flow left over to the developer might be a whole lot of the cash flow in the project. It better not be all. It can't be all, because then you would have a bare transfer of the assets. So back leverage, if you think about it, it's what goes to the okay. Let's find our little diagram. It's more useful to have this as a diagram than as a model, although again I encourage you to do this so you get some money. The developer gets a whole lot of the cash flow. What is this? This is, I think, wrong. It should get all the cash flow kind of before and after or a lot of it. Okay, they get this cash flow. Sorry about that. And then you borrow against that cash flow. So you don't borrow against this. If you borrow against this, there are some very important benefits, and it makes all sorts of sense. But then this is senior to this, and they don't like it. So that's why we do the back leverage. And if you remember, there's some preferred yields to take some cash flow right off the top. And in the last video, we went through this tracking account a little bit, maybe not quite enough, but I've gone through that elsewhere, and you can figure out the timing of the yield-based flip. Okay, and now let's to consider the yield-based flip. Let's just think about a couple of things, and again, think about some concepts rather than just necessarily kind of the Excel modeling. Well, think about a P50 case, and then think about a worst case or a downside case, a P90 or even a P99. worst cases. Anybody who tells you that these and there is a little bit of probabilities in there, but there's also a ton of judgment in computing these P90s and seeing what the it's really an old-fashioned downside case. That's I don't want to get off track, but that's really what it is. And don't be fooled, okay? Don't be fooled into thinking that it's some highly sophisticated probability analysis, okay? You need a standard deviation, and that standard deviation has all sorts of errors you can make in modeling, mistakes you can make in sizing inverters, mistakes, any kind of mistakes you can make that lead to a change in production, even a transmission problem. Okay, so we're going to first consider a case with no tax equity. And if it's no tax equity, you could size the debt based on a couple of things. You could say, okay, well, let's put a DSCR, a buffer in here. And I've got another video. I've got to remember to do that because I do this little experiment to show what a DSCR really means. It's how late you're going to be for a meeting or how late you're going to be for the airport. And you want to you want to leave buffers in, and that's really how you think about risk of just about anything. Oh, I'm getting off track a little bit. Okay, so we make a P50 case, and in this case, I made a P50 case, 40% capacity factor, very high, for a wind project. And I used a little standard deviation, used a norm inverse function to then compute what the P90 is. You should all see that over and over and over and over and over again. And then we size the debt to get us our this is our P50, and we have the DSCR buffer, and then we have a tail. Please, how could you, like these bureaucrats, stop the graph at the end of the debt size and not take the whole project and look at this buffer and this buffer together? And this buffer is the DSCR. If you take the present value of the debt service and the present value of the cash flows, you get the LLCR. And the PLCR is the present value of all of the cash flow compared to just the present value of the debt. So this versus this gives you the value of the tail and how much reduction in cash flow. You take one DSCR or PLCR minus 1 divided by PLCR divided by DSCR. You get the percent reduction in cash flow that you can accept. Good. Okay, and that really all comes from our standard deviation. It all comes from the same thing. I'm going slow. Now notice I have a little fix here. And what this fix means is when you set this up, okay, this time I made here's the norm inverse function, and we put a different standard deviation. So we put a higher standard deviation. Everything comes from standard deviation. We get a downside case, a P99 downside, for example. And then we select one of the cases. So right now I'm doing this, and it's just going to select this case. And then we put in a very simple case. Remember, I said, let's do things really simple. We've got a 1 period construction, and then and that happens to be, if there was ITC, the ITC period, but we have PTC. Okay, and then we get the somewhere down here, we put our ratios in, and this time I put more cash flow going to the tax investor before the flip, because they want the safety of the cash flows. That's what we covered in the last video. And then we have a tracking account. Right now I don't even have any tax equity. That's why the tracking account was there. And then we get some leverage, and we just take the NPV, the debt size is the NPV at the interest rate over the debt tenor of the cash flow available to debt service, and that cash flow available to debt service is the dividends, and I should be very clear on this one, everything is pre-tax. So in a way, it's really easy. There's no circular reference because of the interest deduction you can have on taxes. And then now here is the big deal. When you size the debt, then I made just a little range name, and all I did was in this one, it's really simple. Now, I argue that you can use a UDF to do this a little better, but all I do is fix the repayment and fix the debt service from the debt sizing. And then after that, you can take that fixed debt sizing and use a different, and I did it very quickly here, but you can use a different, come on, capacity factor and see what happens. So let's do this. Okay, so if we have no back leverage right now, we just have a regular old project, and we're sizing it based on the P50. You could size it on something else. Now, if we size it on the P50, and then we lower the capacity factor, that's because I was balancing the balance sheet all day. Okay, really sucked. I put automatic. What am I doing? I fixed it. This should have been going down. Just a minute. There's our P75, P90, and P99. In the P99, things are really, really bad. We fixed the debt up here, and then the actual case is down here. Now, the big deal I just want to tell you about, it's just something very general, not all that much to do with tax equity. Fix the debt. Put a little thing in your model. Now, if you have to use this horrible copy and paste to fix it, fine. You can use that. A UDF is a more elegant way to do that. Far more elegant, but that's another little bit off the subject. So let's put our P90 case here. And so we're just about a one-time DSCR, but we got a little bit of extra buffers here. So if we restructure, we paid everything off. No tax equity. Okay, now let's put it back to the P50 case. Now again, using a little spinner box the Excel technocrats might go nuts with this. If you're making a presentation to some people and trying to get them to understand what the yield-based flip can do, and you've got all sorts of other risks about merchant flows and corporate PPAs and other kind of whatever, I don't know, the P90 and P50 are supposed to take a lot of risks in. Maybe you've got some risks in solar with some degradation, maybe some risks with inverters, with turbines having something else. Okay, now let's put some tax equity financing in. If we put tax equity financing in, okay, let's put, how much? Let's put 40% tax equity. Now, here's what's happening. The tax equity is getting some of the cash flows until they hit their flip, and then they're giving you the rest of the cash flows. So another thing, this should say the total cash flows, and this should say the developer cash flows, not debt service. Sorry about that. Now, if you want to make a sizing based on if you want to make a sizing debt size, and I'm not going to go change it. Okay, so this is the total project cash flows, and this is the developer cash. So the developer cash flow, just so you understand that that's wrong. Now we can do our debt size based on these cash flows, and we just press this one to fix the debt. And so this is now this is the colors are kind of wrong, whatever, but that's the orange line. And then we make a debt service and give ourselves a tail, and we have 1.35 and everything's okay. Ah! Now, if you remember, when we changed it to the P90 case before, we had a PLCR that was just good enough, okay? And the LLCR and the DSCR were the same, okay? But this time, if we lower the overall cash flows, that's going to push the that's going to push the yield-based flip further away. When we push the yield-based flip further and further away, what's going to happen is we have two effects of the declining cash flow. The first effect is just that the cash flow goes down. The second effect is that the timing of the flip changes. So you can see that it's a very different matter lending and doing this back leverage to a yield-based flip and a time-based flip. The time-based flip we're just going to go on into a little minute. So I'm going to do the same thing. I fix the debt, and I'm going to repeat myself, but make a separate little debt size, fix the debt, and then do your credit analysis based on the fixed debt. You've got a structuring part of your people who work on structuring here, and then people who work on credit analysis. And now if we put our P90 case in, for these cases, we thought we could pay off the debt, but this flip didn't happen because we're in the low case, and now our PLCR, I think it was 1.08 before, now it's going down to 0.98, and we've got a DSCR that gets killed here, and we've got a LLCR that's way below 1 in this case. And the only point here is that the yield-based flip, depending if you're going to allow the tax equity to be in a kind of senior position, the yield-based flip is going to be a problem. Now, I'm just going to make one more point. What we could do is, let's get all the way back, okay? Whoops, the other way, okay? We could start here. Well, that's what everything was supposed to be with our P50 and our standard deviation. If we increase the standard deviation, then we have a bigger problem, okay? Whew. Now, if instead of sizing the debt based on P50, we could put our DSCR down to 1. Again, use the little spinner boxes. This took a few minutes to do, really, because I couldn't even get the graphs right. And then you can maybe see, I never understood why in the US people use kind of P99 instead of P50. But now, if you use P99, you've already made the flip occur way out. Now that really, in this case, it reduces the size of the debt. So the P99 versus P50, when you size the debt based on the two, the P99 doesn't just account for the lower amount of cash flow you get from the P99, it also accounts for the fact that the yield, the flip, the yield-based flip will occur later. And my friend Pascal doesn't use the tracking account to do the flip. You want to make that flip, no circular reference, no goal seek buttons, no nothing. That's what the wonderful tracking account method that was in part 2 that I discussed will do. Now, if you fix the debt like this and go the other way and then say, if we have and then you can see that whoops, yeah, hang on, this should have been fixed, this debt size should have been fixed, but okay, again, I did it really quickly, so you can go and fix that yourself. I make a lot of mistakes in these videos on purpose, just to see if you're following me, So here's what happens. Then if you're in the P50 case, well, oh my gosh, we haven't, we've got the ratios that are almost way too high. Maybe what you could do is once you prove that you're in the P50 case, then do some refinancing if you're doing that. So there's some very interesting strategic issues. It's less about the mechanics of the modeling and more about understanding kind of what occurs. All right, that's the yield-based flip. Now let's go back and talk about just a regular old solar project with tax equity. Okay, and I try to put these here, obviously, below. Now, in the if we have a tax equity, we can have a tax equity bridge loan. And it seems, like I said, I'm repeating myself, but it seems that that would be complicated, but it's not. Don't get intimidated. And even better, the amount you can make the tax equity bridge loan just in my example, I made it the total amount of the tax equity. Again, you can some person who's going to get really, they're going to irritate the hell out of me. Oh, no, maybe it's 90% of the tax equity. So what? Okay, put a 90% in. You size the tax equity, and that's given. Now you take the ITC, by getting the fair market value. Now, if there's interest during construction and fees during construction, I have seen a situation where the fees and the interest during construction increase the project cost. There's no question they do that. You can get a higher tax deduction. And then if you apply a fair market value as some sort of percentage on the cost, including the interest and fees, you'll get a little circular reference. Did you see that? Okay. But basically, what I'm trying to say is, for the sake of getting this started, we're just going to say that the tax equity bridge loan is the amount of the tax equity investment. And then you're left with a loan to the developer, the back leverage. And that's going to be a regular old loan with drawdowns, with commitment fees, with upfront fees, with interest during construction. Regular old loan, except it's easier. A heck of a lot easier. Here's why it's so much easier. It's easier because you don't have any taxes, and I already mentioned that. So when you just all this stuff is done on a pre-tax basis, not so hard. Okay, I had to ask that when I was teaching a class. Now, so when you put these loans together, then the next issue is when you make your draws, when you make your sources and your uses of funds, or you call it construction funding M or some crazy thing like that, and it's not nearly that complicated. And I've seen these horrible, disgusting, absolutely, I can't start putting enough bad adjectives here, where a construction financing sheet can take 3,000 lines, and I'm not joking about that. I should have been joking, but I'm really not. You make some sort of cascade where you can say, okay, we begin with the tax equity bridge loan. Just you can talk about just an equity bridge loan, but it's even easier. It's just that loan gets repaid when the ITC comes in, or if the tax equity provider puts a little bit of money in 2 times, maybe 2 months before the ITC date and right at the ITC date, that can happen. You get paid when the tax equity comes in. That's a bridge loan. And then you're left with the rest. And the rest you can say, oh, well, let's put in equity before the debt. And you can even put an equity bridge loan, not a tax equity bridge loan, in to finance the equity. So I just made it the second part equity. I didn't put an equity bridge loan in, but it's not a big deal. I hope I've made some videos on equity bridge loans. They're more and more of a subject. Okay, I don't know what to say. I'm not going to be one of these people who say, give me a comment and tell me what to do and all that. Oh, Jesus, because I never get around to making these videos anyway. It's hard, and you have to spend all day balancing a balance sheet. So we have just some basic parameters. Do we put a tax equity bridge loan? What's the interest rate? It should be a low interest rate. The only risk you're taking is, will the tax equity fulfill the contract? They've written a contract and they've written a financing agreement that says they're going to put X amount of money in, and if there's somebody like J.P. Morgan or Bank of America or whoever it is, Google, Google doesn't do that much of it, I found out, then you've got to make sure they're big companies. They pay a lot of taxes. They shouldn't be, there's not much credit risk associated with those. So you shouldn't have much of a credit spread. On the back leverage, it's a different matter. And we can size it based on the P50 and P90. We can put a debt tenor in and put a tail in, just the same sort of thing we were talking about just before. And then I have a little bit of a small screenshot, and maybe I'm going to just move to our financing case. How's that? So the first thing we can do with this case, and I guess I'm debating whether I should make it a little bit larger. First, we have all this regular old stuff. This time I was a little bit better by putting the timing and the whatever together. Now, the big deal here, too, is, yeah, I'm going to go nuts again. But all of these horrible things where you put the timelines in on a different sheet and you don't have a real final timeline for financing, which has monthly during construction. In this case, I put annual, but in the real world, it would be monthly and then quarterly. And it's a big deal. And to do that, all you need to do is figure out how long the monthly period is and put a little flag here. When I have my generic macros open here. So here I have to do that one. Okay. I just put a new copy of this. Now, for me, this was so wonderful when somebody, Ali, he was the one who taught me this. What he was doing, he was, whenever he had one of these things, he would be manually making brackets. So if I put for the pre this, let's put the pre-ITC period, then we put a true and false. If I put this is less than or equal to our constant, okay, this is the number of months, okay, it gives you a true. Hetty doesn't like the true, and you press Shift Control B, not for bold, and then it takes your little true and false and puts a multiplication and stop with the damn, oops, and of course I didn't put the F4 in here. Sorry about that. Okay, Shift Control R. Okay, that's generic macros. All right, and then we put some tax depreciation in. We put some allocation scenarios in. And in the allocation scenarios, we can take them, and I put some allocation of the income that can be all different, but that's what we don't care about as much. We put some preferred yield in. The preferred yield is a big deal now because that comes right off the top, and that's like operating leverage or financing leverage. That is senior. That little piece is senior. So if you get to a P90 case or a P99 case and you have to pay the tax equity a flat preferred yield, that's a credit risk. All right, and then we have our regular EBITDA, and then we get our debt size. We get our debt size from the fair market value for the tax for the tax equity bridge loan. Okay, I just took this was our capex, I don't know why I put a P5090 EBITDA in. This was the fair market value write-up. We put this in. We take 30% of it. That's our ITC. We put a contribution ratio in, which is to size the tax equity, and that's the size of our tax equity bridge loan. And then we make another sizing of the debt where I always put a flag in, and why you can't compute your flag right here, and I use the one up here, and then you put your P90 in. Solar, we have a P90 and we start everything, so I just made it annual after we made it monthly. We put in our preferred yield, and our preferred yield starts, and we're just putting our preferred yield in for maybe 5 years. You take the preferred yield away, then you have the remaining cash flow. You might give the tax equity even more. So they get a little more cash, and that means at P90, here is the total cash that the tax equity gets here, and it's kind of got a little bit of a flip thing going on because you get lower numbers here and higher numbers there, and I'm just using a P90 because that's traditional what we do. I put a 1.2 times in for the P90, and we take this. Now, when you do this, if you want to do it in a simple way, you can do it much fancier, and there are so many videos on this. If you are smart and you use an if statement, then you can make sure the NPV begins here. And if you put zeros here, and you have to put zero in your if statement, and I can't stand it when people do this. Please. Oh, shit. Okay, you can then multiply it if you want to do it that way. Then this NPV is the size of the debt. So we have the size of this debt here and this debt here. And you notice so far we didn't have anything that relates to the circular reference, with one thing exception here. If we put the IDC and fees and we multiply the 25% on top of the IDC and fees, I almost think that that's kind of silly to do, because you could just say the fair market value is the fair market value. That's what you're supposed to do anyway. Okay. Then we get, and then what we could do, then it gets a little, the one thing that causes some problems is what happens how do you compute the debt to capital for the back leverage? And again, somebody's going to say, here's the rule. I know the rule. I'm a big banker. I know the rule. What I say is just take out the tax equity and take the total amount of the financing minus the tax equity and see what the debt divided by the total capital is, the total project cost without the tax equity. So that's how I computed the debt to capital. And if we get too much debt to capital, you can constrain the debt to capital, and that does cause a circular reference. And then you have to adjust the DSCR, do something else, and don't pay off the debt fast. Please don't do that. You can do this thing that Hetty does where she does this shaping of the whole thing. But then we put in a sources and uses of funds. And here we just have an S curve, the regular old S curve, and then we take our IDC on the bridge loan, just like you do any other IDC, an upfront fee on the bridge loan, just like you do any other, and I'll show you that in just a minute. And the back leverage, you do the same thing. You've got IDC and fees on the back leverage, and you think, oh, there's going to be a circular reference for that, I'm sure. And then you get the total uses of funds. And then the sources of funds, I took the back leverage, the tax equity bridge loan right off the top. Then we moved to the cascade, and I put the equity in, and then I put the debt in last. Okay, you could say, I don't like that. I want to do it a different way, and that's no big deal. And to do that, what I would always do is get the total amount of the commitment, put the commitment in, see how much of that commitment you've used, see how much is left. To get how much you used, you make a little opening balance, and then you use a minimum function. And I'm even doing this without seeing the formula, and it's the minimum of our financing need relative to this. So we we get down to here, and that's the equity bridge loan we have. And then you have the IDC and the fees on that bridge loan, and I put a little flag in for the financial close period. And then you blah, 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 where's the cash flow after the bridge loan? I never know. This is if you press Shift Control E, you get this in the generic macros. If you press Shift Control G, and I always do this to show you how you can make your own little shortcuts yourself. Then you do the same thing, and you put the equity commitment in. So that's the second step. And you put the commitment of the equity up here. And then once you put the equity commitment in, you go down and take the opening balance to see how much you've put in, and then you can use the minimum function with the next element on the cash flow cascade. That's really not very difficult, is it? I've done this so many times, it starts to put me to sleep. And then we have the remaining cash flow. So we have another. That's why it's a little bit of a cash flow cascade. Okay, and it's really not that difficult to do, is it? And then you finally get the back leverage, and you can do the same thing, put the commitment in, although you don't really have to. And then you can, if you wanted a commitment fee, you could get that in, and all of this. Now I suppose the only thing here is once we have this done, and then it's not a big deal. Now, I did not do two things. On the IDC and fees, we could just, let's just for now, why not? Okay, we can, let's do it like this. Put a sum of all the total IDC and fees, and let's call that part of the project cost. And you can see it's really not a lot, is it? If you do that, you get a circular reference, and then you can do a copy and paste, or my favorite, which is a UDF. And I even put a UDF in this model, but I'm too lazy to go through it, and I haven't tested it all out. And it probably, to put a UDF into this model, I guess I can show you. You go to the developer tab and go to macros, and let's get rid of the generic macros, and I put UDF for funding. And I've just done this with another model. So, you're going to yell at me. There is a little bit of coding to do, but basically you do exactly that. All of those formulas we just did, the upfront fees, the commitment, and all that. And basically that will, at the end of the day on the output, it's a little bit too long for now, it'll give you the IDC, the upfront fees, if you want the commitment fees. I shouldn't have put that in there actually, and all that. It'll basically essentially fix those for you, or you can do a copy paste. Okay, not that big a deal. Really, really, really not that big a deal. Now, the other place it could come into play is up here. When I did the debt sizing, I said, well, okay, we're just above the maximum debt. So if the debt that we're actually going to apply is going to be right now the debt applied is this one, and it should be the minimum of either the debt from the DSCR or the debt from the debt to capital. And when you do that, because the debt to capital is fixed, and once we fix the debt to capital, blah, 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 once we fix the debt to capital, then if the project cost goes up, I didn't get that up. If the project cost goes up because of IDC and fees, then the debt goes up because of IDC and fees. But if the debt goes up, the project cost goes up, and you have a circular reference. So I'm not going to do that. I'm going to cheat and just compute the debt from the DSCR, and then we're finished. And then what we need to do is go through our developer analysis. Okay, Now, this is where, and I hadn't really thought of this before, but this is where do we do the developer pre-tax or after-tax? You can do all the sizing of the debt pre-tax and after-tax. I did this pre-tax. So we go down and compute the IRRs. We can get, we don't really have to do this, but we get the equity you put in, which is that middle part. And then we have to pay off the bridge loan, but we get that from the tax equity. So that this is not 100%. You might have to put in a little more equity. So in this case, that's the only equity you put in. And then you walk through a kind of cash flow waterfall. You put in how much comes away from the preferred yield. You get the EBITDA less the preferred yield. You get the remaining cash flow. You get the tax equity cash flow as the from the whatever after the preferred yield. Where is this? Why don't I do this? If you select this whole thing, Shift Control Q, I'm just making all the decimals consistent. Then we get, this is the cash flow that you get after you paid off the debt service, and the debt service comes from that comes from that debt sizing above. Now, you could fix that and then do some other sensitivities just like we did before. I hope this is clear. I really, really hope this is clear. If it's not clear, I suggest we can do two things. I think what I'm going to do is on this one, I've got some, where is the, oh, these are some bad examples. Oh, come on. This one, I've got some exercises. I put some exercise. I can't find the ones that says exercises where I put a bunch of yellow little things in here. And I'm really gonna start changing. I'm gonna start making more case studies and working through those kind of case studies. But that was a little off track. Now, if you would want the project cash flow, again, taxes are not the big issue here. You could take the cash flow before the debt service. You could take the equity cash flow plus the amount of back leverage we're financing. So you're getting everything pre-gearing, pre-leverage. You get the net cash flow, put a little zero in here, and because we've got some monthly cash flows, we use the XIRR. I almost think if you really want to do this, leave the inputs there and blank out everything else and try to do this. And if you find a mistake that I made, good. Okay, sorry. And then you can get the equity cash flow, which is just taking this total net cash flow after debt service and the net, you put the cash inflow you get from the dividends, which is this cash flow after the debt service. You put the money you've taken out from that sources and uses, and then you get the equity IRR. So it's just almost easier. Now, in this case, in this one, if you really would want to get more specific, you could say, let's put in an NOL, let's put in a tax payment for the developer. That totally would be understandable and fine. And I would suggest you then do this whole thing that we showed you here, but this one you could do this after leverage, and that's the one you kind of really want to look at. So you could compute a kind of ridiculous amount of IRRs, but then you can really look at things carefully. And unless when I work through this with people, oh my gosh, they get confused. And when you go through it a little bit with a simple example, it's really not that bad, is it? But you can make these things into monster technocratic Excel engineering, just horrible pieces of rubbish. And I just have to review. You start with project cash flow. You start with project cash flow. Get a project IRR. That you can make as complicated as you want. If you make it too complicated, you're an idiot. Whatever. Then, because for a solar wind plant battery, they're not that bad. And then you put in step by step by step. And if you want to get that tax equity return, you got to go through this inside outside basis. And it's not that bad. It's just rules. Just rules. No interesting strategy. Okay. So I don't think I really did much here. I don't think I'm going to save the file, but I am going to stop the video, and I'm curious to see how much. Oh, only 50 minutes. Okay, very good. So that's part 3.